Imagine you wake up tomorrow with an extra $1,000 in your bank account. Maybe it's a tax refund, a bonus from work, or just money you've managed to save after months of discipline. It's not a fortune, but it's enough to make a difference if you use it wisely. Now, pause for a moment and ask yourself, what would you actually do with that money? Would you let it sit in your checking account, watch it disappear on small purchases, or take a chance on the latest hot stock or crypto coin everyone's talking about? Here's the uncomfortable truth. Most people, when faced with this exact scenario, end up making decisions that cost them far more than they realize. They chase quick wins, fall for hype, or simply do nothing, missing out on opportunities that could have quietly transformed their financial future. The difference between turning $1,000 into a stepping stone or a wasted chance isn't luck, it's knowledge, mindset, and strategy. In a world where financial headlines scream about overnight millionaires and market crashes, the way you handle your first $1,000 investment can set the tone for your entire wealth journey. The stakes are higher than you think, and the smartest moves are rarely the most obvious. Before you make a decision you'll regret, let's uncover what most people get wrong and what you can do differently. Starting right now, everywhere you look, someone is promising a shortcut to wealth. Social media is flooded with stories of people who turned a few $100s into a small fortune overnight buying the right meme stock, jumping on the latest cryptocurrency, or following a viral, sure thing investment tip. The headlines are irresistible. How I made $10,000 in a week trading Dogecoin. This one stock could change your life. Don't miss the next Bitcoin. It's easy to feel like you're missing out, especially when friends or influencers brag about their wins. The fear of being left behind, the classic FOMO, pushes people to act fast, often without understanding what they're really getting into. But behind every viral success story, there are thousands of silent failures. Take the GameStop frenzy of 2021. For a brief moment, it seemed like anyone could get rich by buying shares and holding on for dear life. Some did, but many more bought in at the peak, only to watch their savings evaporate as the price crashed back to earth. The same pattern played out with countless cryptocurrencies. In 2022, the collapse of Luna and the implosion of FTX wiped out billions in investor money, leaving even seasoned traders stunned. History is full of these cycles: the dot-com bubble of the late 1990s, the housing boom and bust of 2008, the penny stock scams of every decade. What's most striking is that intelligence and education offer little protection. Doctors, engineers, even financial professionals have been caught up in the hype, convinced that this time is different. The promise of easy money is powerful enough to override caution, research, and common sense. The reality is that markets are designed to separate the impatient from their money. For every person who gets lucky, there are countless others who lose quietly, learning too late that the fastest way up is often the fastest way down, if you're tempted by the next big thing. Remember, the stories you hear are the exceptions, not the rule. The real cost of chasing quick gains isn't just lost money, it's lost time, lost confidence, and sometimes lost trust in the entire idea of investing. Before you risk your $1,000 on a promise, ask yourself, do you want to be a headline or do you want to build real, lasting wealth? It's easy to get swept up in the chase for the highest returns, but the smartest investors know that true wealth isn't built on lucky bets, it's built on resilience and long-term thinking. Instead of asking, how much can I make and how fast? They ask, how can I protect what I have, grow it steadily, and keep my options open no matter what the market does? This shift in mindset is what separates those who survive and thrive from those who burn out after a few lucky wins. Legendary investor Warren Buffett once said, "The first rule of investing is don't lose money. The second rule is don't forget the first rule." It sounds simple, but it's a philosophy that has protected generations of investors from the kind of catastrophic losses that wipe out years of hard work. Buffett's approach isn't about chasing the hottest trend, it's about building a foundation that can weather storms, adapt to change, and quietly compound over time. Consider the story of someone who invested steadily through the ups and downs of the 2008 financial crisis. While many panicked and sold at the bottom, Those who focused on resilience, diversifying their investments, keeping some cash on hand, and refusing to gamble everything on a single bet emerged stronger. They didn't just survive the crash. They were positioned to take advantage of the recovery, buying quality assets at bargain prices while others were still licking their wounds. The real purpose of investing isn't to get rich overnight. It's to create a safety net, to give yourself choices, and to build a future that isn't at the mercy of every market swing or economic headline. When you focus on resilience and optionality, you're not just protecting your $1,000. You're building habits and systems that will serve you for a lifetime. The smartest investors aren't the ones who make the biggest splash. They're the ones who stay in the game year after year, quietly growing stronger while others chase shadows. Starting with $1,000 might not feel like much, especially when you see headlines about million-dollar portfolios and overnight riches. But the truth is, every great investor began with a small first step. The psychological power of starting small is often underestimated. When you invest a modest amount, you're not just putting money to work, you're building the habits, discipline, and mindset that will shape your financial future. Think of your first $1,000 as tuition for the real-world school of investing. With a smaller sum, your mistakes are less costly, and your wins, no matter how modest, teach you lessons that compound over time. The process of researching, choosing, and monitoring your investments builds confidence and sharpens your instincts. You learn by doing, not just by reading or watching others. This is where the magic of compounding comes in. Even small amounts, invested wisely and consistently, can grow into something significant over years and decades. Albert Einstein reportedly called compounding the eighth wonder of the world. The earlier you start, the more time your money has to multiply, not just through returns, but through the habits you reinforce with every decision. Contrast this with the mindset of betting. Betting is about chasing a quick win, hoping for a lucky break, and often risking more than you can afford to lose. Building, on the other hand, is about patience, process, and progress. It's about laying one brick at a time, knowing that a strong foundation will support whatever you build next. When you approach your $1,000 as the beginning of a lifelong journey, not a lottery ticket, you set yourself apart from the crowd. You're not just hoping for a windfall. You're creating a system that can weather setbacks and seize opportunities. In the end, the difference between betting and building isn't just about money, it's about who you become along the way. Before you put a single dollar to work, pause and ask yourself a few critical questions. This checklist isn't just a formality, it's the difference between investing with intention and stumbling into costly mistakes. First, what's your goal? Are you investing to grow your wealth over decades, save for a specific purchase, or build an emergency cushion? Without a clear goal, it's easy to get distracted by every shiny opportunity. For example, someone who invests their $1,000 in a volatile tech stock hoping for a quick double might panic and sell at the first sign of trouble, missing out on long-term gains or, worse, locking in a loss. Second, what's your timeline? If you'll need the money in a year, your strategy should be very different than if you're investing for retirement 30 years from now. Imagine putting your $1,000 into a 5-year certificate of deposit, only to realize you need the cash for an emergency next month. Or on the flip side, investing in a risky startup when you can't afford to wait out the ups and downs. Third, what's your risk tolerance? Be honest. How would you feel if your investment dropped by 20% overnight? Some people can stomach big swings while others lose sleep over small losses. If you overestimate your risk tolerance, you might bail out at the worst possible moment, turning a temporary dip into a permanent loss. Fourth, what do you actually understand? Legendary investor Peter Lynch famously said, "Never invest in any idea you can't illustrate with a crayon." If you can't explain how an investment works, what drives its value, and what could go wrong, you're not ready to put your money in. Countless people have lost fortunes chasing complex products or can't miss opportunities they didn't truly grasp. Think of the 2008 mortgage crisis, where even professionals misunderstood the risks. Skipping these questions is like setting out on a road trip with no map, no destination, and no idea how much gas you have. You might get lucky, but you're far more likely to end up lost, stranded, or worse. The smartest investors treat these questions as non-negotiable. They know that clarity on goals, timeline, risk, and understanding is the foundation for every smart decision that follows. Before you invest your $1,000, make sure you can answer each one. Your future self will thank you. Even the most well-intentioned investors fall into predictable traps, mistakes that quietly erode wealth and confidence. The first and most common is chasing hype. When a stock or crypto asset is all over the news, it's tempting to jump in, fearing you'll miss out. In 2021, millions rushed to buy Dogecoin after viral tweets sent its price soaring. But as the hype faded, Dogecoin lost over 80% of its value, leaving latecomers with heavy losses. Smart investors resist the urge to follow the crowd. They focus on fundamentals, not headlines. Next is ignoring fees. Many people overlook the impact of transaction costs, management fees, or hidden charges in investment products. Over time, even a 1% annual fee can eat away thousands from your returns. For example, if you invest $1,000 in a fund charging 2% per year instead of 0.2%, you could lose hundreds in fees over a decade, money that could have compounded for you. Smart investors always check the fine print and choose low-cost options whenever possible. Underestimating risk is another classic mistake. In the bull market of the late 1990s, tech stocks seemed unstoppable. But when the dot-com bubble burst, many portfolios lost half their value or more. People who thought it can't happen to me learned the hard way that every investment carries risk. Smart investors ask, what's the worst-case scenario? And prepare accordingly. Never betting more than they can afford to lose. Concentrating putting all your money into one stock, sector, or asset is a recipe for disaster. In 2008, employees at companies like Lehman Brothers and Enron lost not only their jobs but also their retirement savings, which were heavily invested in their own company's stock. Smart investors spread their bets, knowing that even the best ideas can go wrong. Finally, failing to diversify leaves you exposed to unpredictable shocks. A portfolio of just a few assets can be wiped out by a single event: a bad earnings report, a regulatory change, or a market crash. Data shows that diversified portfolios recover faster and suffer less during downturns. Smart investors build resilience by owning a mix of assets, industries, and geographies. Most people learn these lessons the hard way. The smartest investors learn from history, avoid these traps, and quietly build wealth while others chase the next big thing. Imagine you're carrying a basket of eggs across a rocky path. If you put all your eggs in one basket and trip, you lose everything in a single moment. But if you spread those eggs across several baskets, a stumble might break a few, but you'll still have plenty left. This simple analogy captures the essence of diversification. The most reliable defense against the unpredictable nature of markets. History is filled with examples that prove the wisdom of spreading risk. In the early 2000s, many investors poured their savings into technology stocks, convinced that the internet boom would last forever. When the dot-com bubble burst, those who had bet everything on tech saw their portfolios decimated. Meanwhile, investors who held a mix of stocks, bonds, and other assets weathered the storm far better, often recovering their losses much sooner. Diversification isn't just about owning different stocks. It's about balancing your investments across asset classes: stocks, bonds, real estate, cash, and even alternative assets like commodities or REITs. Each asset responds differently to economic events. When stocks fall, bonds often rise. When real estate slumps, cash can provide stability. By holding a variety, you reduce the impact of any single setback. Consider the 2008 financial crisis. Real estate and banking stocks collapsed, but government bonds and gold surged as investors sought safety. Those who diversified didn't escape losses entirely, but they avoided the catastrophic wipeouts that hit those who concentrated their bets. Even legendary investors like Ray Dalio and John Bogle emphasized diversification as the cornerstone of their strategies. Dalio's all-weather portfolio is designed to perform in any economic climate by balancing risk across multiple asset types. Bogle, founder of Vanguard, championed low-cost index funds that automatically diversify across hundreds of companies. The lesson is clear. No one can predict the future, but everyone can prepare for it. Diversification doesn't guarantee profits, but it does protect you from the worst-case scenarios. It's not about avoiding risk altogether, it's about making sure that no single mistake or market event can take you out of the game when it comes to investing. $1,000? The options can feel overwhelming. But history and experience show that certain strategies consistently outperform the latest hot tip. Here are 5 practical, time-tested ways to put your money to work, each with its own strengths, drawbacks, and ideal fit. Point 1. Low-cost index funds or ETFs. Index funds and exchange-traded funds, ETFs, track the performance of entire markets, like the S&P 500. The pros? They offer instant diversification, low fees, and require no stock-picking expertise. Over decades, index funds have outperformed most actively managed funds and individual investors. The main con is that returns mirror the market. There's no chance for outsized gains, but also less risk of catastrophic loss. This approach is best for those who want steady, long-term growth without constant monitoring. Compared to chasing the next big stock, index funds quietly build wealth while others gamble and lose. 2. Building an emergency fund. It might not sound exciting, but setting aside cash for emergencies is one of the smartest investments you can make. Life is unpredictable. Medical bills, car repairs, or job loss can strike at any time. An emergency fund keeps you from dipping into investments or racking up high-interest debt when the unexpected happens. The downside? Cash in a savings account earns little interest and doesn't grow like stocks or real estate. But the peace of mind and financial stability it provides are priceless. This is ideal for anyone without at least 3 months' living expenses saved. In contrast to risky bets, an emergency fund is your financial safety net. 3. Investing in skills or education. Sometimes the best investment isn't in the market, it's in yourself. Using $1,000 to take a course, earn a certification, or learn a new skill can pay off for decades. The pros are clear: higher earning potential, more job security, and greater adaptability in a changing economy. The con is that returns aren't immediate or guaranteed, and you need to choose wisely. Some courses offer little real-world value. This strategy is perfect for those early in their careers or looking to pivot. Unlike speculative trades, investing in yourself compounds over a lifetime. 4. Fractional real estate or REITs. Real estate investment trusts, REITs, and fractional real estate platforms let you own a piece of property or a portfolio of properties with a small amount of money. The pros include exposure to real estate's long-term growth and regular income from rents or dividends. The cons? REITs can be volatile, and some platforms charge high fees or have limited liquidity. This option suits those seeking diversification beyond stocks and bonds, but who aren't ready to buy property outright. Compared to buying a single stock, REITs spread your risk across many properties and markets. 5. Starting a micro business or side hustle with $1,000. You can launch a small online store, freelance service, or creative project. The upside is unlimited. Many successful businesses started with less. You control your destiny, learn valuable skills, and potentially create a new income stream. The downside is risk. Most side hustles take time to become profitable, and some never do. This path is best for self-starters with a clear idea and willingness to hustle. Unlike chasing trends, building a business puts you in the driver's seat and can transform your financial future. Each of these strategies beats the hot tip approach because they're grounded in reality, not hype. They build resilience, flexibility, and real wealth one smart decision at a time. While it's tempting to put every dollar into stocks or funds, some of the highest returns come from investing in yourself. History is full of examples where a modest investment in skills, knowledge, or relationships led to life-changing opportunities. Consider Warren Buffett, who credits a $100 Dale Carnegie public speaking course with transforming his career. That single investment didn't just make him a better communicator, it opened doors, built confidence, and helped him become one of the world's most successful investors. In the modern era, stories like Sarah Blakely's stand out. With just $5,000 in savings, she invested in learning about hosiery manufacturing and patent law, eventually founding Spanx, a billion-dollar company. Her willingness to spend on education, networking, and prototypes turned a small sum into a global brand, even in less dramatic cases. The pattern holds. People who use their resources to learn new skills, earn certifications, or build professional networks often see their earning power and opportunities multiply. The beauty of investing in yourself is that the returns are often exponential and can't be taken away by market crashes or economic downturns. A new skill can lead to a promotion, a side hustle, or a career pivot. Expanding your network can connect you to mentors, collaborators, or clients you'd never meet otherwise. Even a small investment buying books, taking an online course, or attending an industry event can pay off for decades, unlike stocks or real estate. The value of self-investment compounds in every area of your life. It's the one asset that grows with every effort you make. When you allocate part of your $1,000 to building your own capabilities, you're not just investing in the market, you're investing in the most resilient, adaptable asset you'll ever own, yourself. Imagine your financial life as a well-built house. A strong house doesn't rely on a single pillar. It stands on a foundation of many supports, each serving a different purpose. The same principle applies to investing your $1,000. By combining different strategies, you create a portfolio that can withstand storms, adapt to change, and provide comfort no matter what the future holds. Start by ensuring liquidity, having cash or easily accessible funds for emergencies. This is your safety net, the equivalent of a sturdy roof that keeps you dry when unexpected rain falls. Next, add flexibility by spreading your investments across different assets, a portion in low-cost index funds for steady growth, a slice in REITs or fractional real estate for diversification, and a commitment to self-investment for long-term adaptability. Each element plays a unique role, just like walls, windows, and doors in a house. Consider the story of someone who faced a sudden job loss. Because they had an emergency fund, they didn't have to sell investments at a loss. Their diversified portfolio meant that while some assets dipped, others held steady or even grew. And because they'd invested in new skills, they were able to pivot quickly into freelance work, keeping income flowing during tough times. Adaptability is the secret ingredient. Markets change, economies shift, and personal circumstances evolve. A resilient portfolio isn't static, it's reviewed and adjusted as life unfolds. By blending liquidity, flexibility, and adaptability, you're not just chasing returns. You're building a financial structure that can weather whatever comes next. In a world full of uncertainty, this approach offers peace of mind and the freedom to seize new opportunities as they arise. Before you invest a single dollar, there are a few hard rules you should never break, mistakes that have quietly destroyed more fortunes than any market crash. First, never invest while carrying high-interest debt. Credit card balances or payday loans can wipe out any gains you might make, trapping you in a cycle of payments that grows faster than your investments ever could. Many people have watched their savings evaporate simply because they ignored this basic rule. Second, steer clear of unregulated schemes and too-good-to-be-true offers. From Ponzi schemes to shady crypto projects, countless investors have lost everything chasing promises of guaranteed returns. If it isn't regulated or transparent, walk away no matter how urgent or exclusive it sounds. Third, avoid emotional trading. Acting on fear or greed, panic selling during a dip, or buying into hype has ruined more portfolios than bad luck ever could. The stories are everywhere. People who sold at the bottom in 2008, or who bought at the peak of a meme stock frenzy only to regret it for years. Finally, never ignore the fine print. Hidden fees, lockup periods, or unclear terms can quietly drain your returns. The smartest investors always read the details, because missing them can cost you everything you've worked for. If there's one secret that separates successful investors from the rest? It's understanding the power of time. While headlines celebrate overnight millionaires and viral success stories, the reality is that true wealth is almost always built slowly, through years of steady, smart decisions. The myth of instant riches is seductive, but it's also dangerous, leading many to take reckless risks or give up too soon. History tells a different story. If you had invested $1,000 in a simple S&P 500 index fund in 1990 and left it alone, by 2020 it would have grown to over $13,000 without any market timing, hot tips, or lucky breaks. That's the magic of compounding. Small gains, reinvested year after year, snowball into something extraordinary. Even legendary investors like Warren Buffett built their fortunes not through a single brilliant move, but by letting time and discipline do the heavy lifting. Contrast this with the countless stories of people who chase the next big thing, only to lose everything in a matter of months. The difference isn't intelligence or luck, it's patience. The market rewards those who stay the course, ignore the noise, and let their investments grow quietly in the background. Wealth building isn't about finding shortcuts. It's about making smart choices, sticking with them, and giving them time to work. The earlier you start, the more powerful this effect becomes. In the end, the most valuable asset you have isn't money, it's time. Use it wisely, and your $1,000 can become the foundation of a future you never thought possible. Investing. $1,000 may seem like a small step, but as you've seen, it's a decision that can shape your financial future in ways you might not expect. The smartest investors don't chase hype or gamble on the latest trend, they build resilience, diversify their strategies, and invest in themselves. They ask the right questions, avoid the common traps, and understand that time is their greatest ally. Every dollar you put to work today is a seed for tomorrow's security. Freedom and opportunity. The urgency is real. The longer you wait, the more opportunities you miss, not just for growth, but for learning and building habits that last a lifetime. Don't let fear, confusion, or the myth of overnight success hold you back. Start with what you have, make thoughtful choices, and let your journey begin now. Take a moment to reflect. How have you approached investing in the past? What would you do differently after hearing these lessons? Share your experiences and questions in the comments below. Your story might help someone else avoid a costly mistake. If you found value in this deep dive, subscribe for more myth-busting, practical financial analysis. Here, we don't just follow the crowd, we learn from history, challenge assumptions, and build real wealth, one smart decision at a time. Your future self will thank you for starting today.